Hi, I'm Natalie Breen from CityWire, and joining me today is Haig Bathgate from Tcam. We're going to have a bit of a whistle-stop tour of the biggest themes in financial markets at the moment. So Haig, it might have been a bit of a snooze-fest budget, but it certainly hasn't been a snoozy 18 months. I think investors and the UK public alike are feeling pretty battle-weary from some of the shocks of 2016. But some of those shocks are really still yet to manifest themselves. Article 50 is not yet triggered. We haven't really seen what's going to properly play out in the States. European elections are still coming. How are you as an investor keeping a level head? Are you an optimist or a pessimist right now?
Well, we're kind of a bit of both, to be honest, which is an eloquent way of not answering the question. But I think generally we're quite positive in the outlook for the underlying global economy. The US in particular is becoming self-sustaining and stronger all the time. However, we think that valuations in markets have run ahead of themselves. And for that reason, we think that investors are overly optimistic. There's too much good news priced in. And for that reason, on a tactical basis, we've started to implement a degree of portfolio insurance in our clients' portfolios.
So last year, obviously, there was risk was taken firmly off the table. It seems to be coming back on slightly now, with the investors perhaps looking to Asia, riskier markets, to find returns. How are you playing this?
Yeah, I think it's quite interesting. I think people feel they maybe missed out a bit last year. So you've got this classic case of investors trying to catch up, which is always a dangerous sign. We're quite cautious in the outlook for Asia. We had been quite heavily weighted towards there last year and actually the previous year too. But we do know from history that when the US starts to increase interest rates, that's generally bad news for emerging markets. It's bad news for two reasons. Firstly, a lot of emerging markets have dollar-denominated debt. That's not nearly as significant a feature as it was before because they fund a lot of the debt locally. But secondly, as interest rates start to increase in the US, US investors, who are still the dominant investors globally, start to repatriate funds back to the US where they're going to get a higher risk-free rate.
So we're sort of coming to the end of Q1 asset allocation time. What's your outlook for the next quarter and where are you going to be looking?
Well, we still think that the big thing to watch out for is inflation, persistent inflation rather than transitory inflation. So the kind of inflation that we've seen in the UK is one-off by implication. The currency falls, it creates cost push inflation, and that rolls out the figures within 12 months. But persistent inflation is the thing that will make central banks react and increase interest rates. And we think we're starting to see that, particularly in the US. In the US, you've got unemployment below 5%. You have less of a globalisation stance, which increases wage inflation, and we really think that that's going to start coming through and persisting. So we're starting to really look at ways of, and we have been for some time, of picking up inflation protection in portfolios.
So where is your biggest exposure at the moment?
We still like global equities. We're allocating a lot to global equities. We like value as a style. We know that large cap quality or growth has outperformed very significantly for a prolonged period of time. And we think, again, the valuation extremes between value type companies and quality companies is unsustainable and will reverse. We like inflation linked protection, any kind of real asset we're fans of, given our views on inflation too. And we don't like bonds or any asset with any kind of duration in it. One, because we're worried about the huge sensitivity as interest rates start to rise, but two, the terrible liquidity characteristics.
If you had just one piece of advice to say to your clients right now, what would it be?
I think ultimately it's to kind of stay calm. The big thing that we're seeing is, and more so than ever before, is with the immediacy of noise and the immediacy of news, it creates lots of noise and lots of false signals rather than fake news. But it does unsettle people, and I think as we go into probably periods of rising geopolitical risk, it's a case of just trying to sort of look at the wood for the trees type of thing, and not panic and take a longer term view.
Haig, thank you very much.
Thank you.